Please join me in welcoming Bill and David. Okay.
Hi, Kevin.
Morning, guys. Okay. Welcome. Okay. Now, Bill, let's start with you. This time last year, we talked about where would the stock come from. We really couldn't see how the investment market would actually be moving at all this year. But we did suggest that the newly developed stock would probably be the first to hit the market, and that seems to have been the case. So given we got it broadly correct this year, what's your tip for the year ahead?
Well, we did get it broadly correct for this year, but for the year ahead, I mean, I think to me one of the most important things that's happening right now that I'm seeing is, we're going through this cycle, but we're also going through phases in the cycle, which we always do. And to me, we seem to pretty much have gone through the denial phase that you always have when you get a down cycle. And we're sort of into the acceptance phase, so that's a good thing. So as well as the sort of categories of potential vendors we talked about last year, which was developers and people with fixed-end or closed-end funds, and some people looking to sell because they're under a little bit of pressure. Now we're starting to see people selling for other reasons. And some of those people who bought before 05 or 06, who have good profits in their property, who realize it's probably maxed out for the next at least year or two, and looking to sell and recycle their capital to put it into other investments or put it into development projects. The other thing we're seeing is some people who did buy in 06 and 07, who bought for value add purposes or core plus type funds, who've added the value they can add to the property, they've leased it up, and once again, they realize it's pretty much maxed out for the next couple of years. So even though they're going to take a loss, they're going to go ahead and put the property on the market and sell it, just because that was the purpose they bought it for. That's what their investors put the money in for. Even though they're going to take a loss, they might take a 25% loss, but that's actually not as bad as other people have done around the market. So that's something that's really changed, I think, in the last probably 2 or 3 months.
So you think that sort of the level of investment activity next year will be similar to this year, sort of a moderate level?
I think it might actually be a little better now. Okay. We talked about this over the last couple of days, and I think my initial reaction was it probably would be similar. But having thought it through and just thinking about some of the conversations I've had with people, I think we could see a little bit more transaction activity, and that's more because I think everyone's sort of getting used to. I mean, this is the market we're in. I think the grown-ups are really the only ones left playing in the market. Everyone sort of who's around has been through markets like this, so they've accepted where things sit, and the people who decide to sell will have a reason, and the opportunities will be there for those who want to buy. And so I think potentially we could have a little bit more activity.
Okay. Now, in the last 12 months in Brisbane and indeed around Australia, foreign investors have been an important part on the buy side. With the Australian dollar now reaching parity or close to parity, do you see that continuing?
I think the dollar being as strong as it is not going to be good for that. I mean, our international guys, our international investment guys, have just got back this week from a trip to Europe and to Asia, and they've come. I talked to them yesterday just to sort of get the latest from them, and they said that the European buyers, and we had a lot of Germans and Swiss and stuff through the market here last year, and actually bought that HQ South Tower property, but they think there's going to be less demand from the European market this year because the hedging costs are too high, and the requirements of those investors are very specific: new buildings, high sustainability ratings, long lease expiry profiles, and probably without a lot of, not many of them will buy anything but that, and there's just not that much of that product around. And they've bought, probably offshore investors have bought about 70% of the buildings priced over $50 million in the last 2 years, so a lot of those investors have already bought something. Some are buying multiple properties, but the Europeans probably will not have as much demand. The Asian market, on the other hand, our guys think will be about like it has been the last year or so. I mean, they still think there's demand there. As more of the Asian institutional investors come into the market, it sort of creates a bit of interest among their peers in their markets. The 275 George Street sale to K-REIT really was something that we're able to utilize when Santos Place was sold to P&B from Malaysia, because they said, well, K-REIT bought in Brisbane, we know them, they know what they're doing, so we're happy to follow them into that market.
Okay, so what about private investors? They were a big part of kicking this investment cycle off when values did fall early in 2009. Do you see private investors playing much of a part in the market in the next 12 months?
Yeah, well, private investors, historically, and I can't see why it's going to change going forward, have had these little windows of opportunity when they can play in the market, and we're in one of those windows now. They're often crowded out of the market by, when the domestic institutions are in the market, they get crowded out. When the offshore buyers are in the market, they get crowded out. So there's only little pockets of time when they can get in and get good deals. Probably last year was, just sort of like Ray was saying in his talk, was probably the optimum time, but there really weren't that many willing vendors out there. There's some properties on the market, but then they got withdrawn because the vendors didn't get the price they wanted. So I think there's still another couple of years of potentially decent buying for the privates, and there are certainly a lot of high net worth, very high net worth people out there looking around. At the sort of step down from that on the net worth table, another phenomenon that's really come in the last few months is the syndicators are back in the market for the first time in a long time, and that's because they have access to high net worth individuals who are investing with them in their syndicates. And there have been a number of, I think we've got a slide up with 3 of the properties shown on that slide sold to syndicators. And that's something that I think we'll continue to see for a little while. If the interest rates kick up, that's going to make it difficult for the syndicators because they've got to distribute 8% plus to their investors. And if interest rates kick up, it could be difficult for them to do that.
Okay. David, let's bring you into the conversation now. Of course, the decisions on the investment market and timing are also very much linked to what's going on in the leasing markets. And of course, Brisbane's been hit pretty hard, but so has everywhere. How are you reading the market now? How's the level of demand, and what's the sort of outlook for the year ahead?
I think the outlook for the year ahead is a lot more positive than it was 6 months ago. The super profits tax on the resource market shut everything down because that's really been the major source of inquiry over the last 12 months. The inquiry is very patchy. I come to work some days and the phone rings and I call tenants and they talk to me and they're happy to chat and they've got inquiry. I come to work the next day and I scratch my head and I sit there and I call tenants and they're not there and they don't want to chat and it's all doom and gloom. So it's very, very, very patchy at the moment. We've seen some really positive signs in the last couple of months. And yes, it's all resource. We've just leased 5,000 square metres of additional space to Bechtel at HQ, and that was growth. We've just seen Adani, which you'll see in the paper this morning. The Indians come over and they've taken 1,000 square metres at AMP Gold Tower. That's growth. And the Queensland Gases and the Santoses of the world have obviously gone into office buildings, and then once they've signed the first trench of space, they've decided to come back and take extra space. So very much resource focused. I think if you took resource out of Brisbane at the moment, it would be a very quiet place.